Hey everyone! Today I'm excited to share my journey on how I built a $10,000 investment portfolio completely from scratch, with no prior experience or big starting capital. I'll walk you through the strategies I used, the mistakes I made, and the mindset shifts that helped me grow steadily. Whether you're just starting out or looking for practical tips to boost your portfolio, this story is for you. Let's dive in and get you on the path to financial growth. Today we will talk about how I built a $10,000 portfolio from scratch. So before we start, make sure to hit the like button and subscribe to my channel. 1. Laying the educational foundation. Building a substantial investment portfolio from zero can seem daunting, but with discipline and strategy, it's achievable. When I started, I had no prior experience, no initial capital, and many doubts. My goal was to grow a $10,000 portfolio by consistently investing and learning. The first step involved educating myself extensively on financial literacy. I read books, followed finance blogs, and joined online investing communities. Understanding basic concepts such as asset allocation, risk tolerance, and market cycles gave me confidence. I focused on creating a solid foundation of knowledge before risking real money. This education phase lasted about 2 months but was crucial to my success. I realized that investing isn't about quick wins, but about patience and informed decisions. 2. Budgeting for investment capital. Next, I concentrated on setting a realistic budget for monthly investments. Without disposable income, building a portfolio is impossible. I analyzed my monthly expenses and identified areas where I could cut back, eating out less, limiting subscriptions, and minimizing impulse purchases. From this budgeting exercise, I allocated $300 per month strictly for investments. This sum felt manageable and wouldn't disrupt my living standards. I opened a brokerage account with low fees and no minimum balance, favoring platforms with educational resources and user-friendly interfaces. Automating monthly contributions ensured I stayed disciplined, avoiding the temptation to skip investing when market conditions seemed uncertain or when I felt financially tight. 3. Diversification, spreading the risk. Diversification was a core pillar in building my portfolio. Instead of putting all my money into individual stocks, I opted for a mix of ETFs, exchange-traded funds, index funds, and dividend-paying stocks. This approach helped spread risk across sectors and asset classes. I allocated 50% of my investments into broad market index ETFs, like the S&P 500, to capture overall market growth. Another 30% went into dividend-paying stocks, which provided steady income and reinvestment potential. The remaining 20% I reserved for growth stocks with higher volatility, but promising long-term potential. This balance allowed me to protect against downturns while still capturing upside opportunities. I reviewed my portfolio quarterly to rebalance and adjust allocations as necessary. 4. Ongoing learning and market awareness. Building the portfolio required constant learning and adapting. I dedicated time weekly to reading financial news, earnings reports, and market analysis. Learning to interpret financial statements and company fundamentals helped me identify undervalued stocks. I also tracked macroeconomic indicators such as interest rates, inflation, and employment data that influenced market trends. Over time, I developed the discipline to avoid emotional decisions during market volatility. Instead of panic selling during downturns, I used those opportunities to buy quality assets at lower prices. This strategy of buying the dip accelerated my portfolio growth and cemented my belief in long-term investing. 5. Harnessing the power of compounding. A crucial milestone was reinvesting dividends and capital gains back into the portfolio. Rather than withdrawing profits, I committed to compounding my returns by continuously purchasing additional shares. Dividend reinvestment, in particular, created a snowball effect, steadily increasing the number of shares I owned without additional cash input. This compounding effect became a major growth engine, especially as my portfolio crossed the $5,000 mark. To maximize growth, I avoided lifestyle inflation, keeping my spending steady even as my net worth increased. This mindset allowed me to funnel more capital into my investments over time, accelerating progress toward my $10,000 goal. 6. Tax efficiency and strategic account use. Tax efficiency was another important consideration. I educated myself on tax-advantaged accounts such as Roth IRAs and HSAs, which offered growth potential without immediate tax liabilities. I prioritized contributing to these accounts first to shelter gains from taxes. In my taxable brokerage account, I use strategies like tax loss harvesting to offset gains with losses, reducing tax burden. I also held investments for more than a year to benefit from lower long-term capital gains tax rates. Understanding tax implications helped me keep more of my investment returns and accelerate portfolio growth. It reinforced the importance of not just earning returns, but keeping them efficiently. 7. The role of community and accountability. Community and accountability played a pivotal role in maintaining my motivation. I joined online investing groups where members shared their strategies, successes, and setbacks. This camaraderie helped me learn from others' experiences and stay accountable to my goals. I also found value in following financial influencers and mentors who emphasize the importance of consistency and patience. Celebrating small wins and progress milestones kept me motivated during slow periods. Sharing my journey with friends and family created external accountability, making me less likely to abandon my plan. Building a $10,000 portfolio was as much about mental discipline and support as it was about money. 8. Looking ahead. Growth beyond $10,000. Finally, reaching my $10,000 portfolio milestone was a proud moment, but also the beginning of a new phase. With this foundation, I plan to expand my investments into alternative assets like real estate crowdfunding and peer-to-peer lending for further diversification. I also aim to increase monthly contributions as my income grew. The key lessons I learned were to stay educated, remain disciplined, and view investing as a lifelong journey. Building a $10,000 portfolio from scratch requires patience, consistency, and smart decision-making, but it's entirely possible with the right approach. 9. Overcoming challenges and staying resilient. The journey to building a $10,000 portfolio was not without obstacles. Market downturns, unexpected expenses, and moments of self-doubt tested my commitment. Early on during volatile periods, it was tempting to panic sell or halt contributions altogether. However, I reminded myself of my long-term goals and the principles I had learned. I practiced mindfulness and maintained a calm perspective, focusing on what I could control, consistent investing and ongoing learning. I also created an emergency fund to cover unexpected costs, which prevented me from tapping into my investments prematurely. 10. The importance of goal setting and tracking progress. Setting clear, measurable goals was instrumental in my success. I broke down the $10,000 target into smaller milestones, such as reaching $1,000, $5,000, and so on. This made the journey less overwhelming and provided regular opportunities to celebrate progress. I tracked my portfolio's performance using spreadsheets and apps, which helped me understand returns, monitor diversification, and make informed adjustments. Reviewing progress monthly reinforced accountability and highlighted areas needing attention, such as rebalancing or increasing contributions. These habits cultivated discipline and encouraged a proactive approach rather than passive investing. But if you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.